Welcome back. You're watching Traders Corner, and joining me as always is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, starting off as we always do with the S&P 500, it's a slow grind, but it's a grind to greatness as opposed to our own market.
Yeah, it is. So I'm going to show a sort of a shorter term chart as we always do, and then we'll zoom out a little bit and look at the longer term as well. So here's the chart, the shorter term one. When I say shorter term, we're looking at about 6 months worth of trading history here. And you can see still that upward sloping channel that began in April is still very much intact. On the show last week, I said that it looked as if it could pull back to that lateral support at about 2,800. It has done that, and it's reversed up off that level. And it's now bumping up against the highs that we saw in early August and looking as if it might very well want to take out those highs and then go on towards the upper boundary of this bigger channel pattern. On the show last week, I said just keep in mind there's a possibility that it forms the right shoulder of a head and shoulders pattern, but it doesn't appear to be doing that. And in fact, if you go back and you look, there's been there's been 3 other head and shoulders patterns within this upward sloping channel since it began, and all of those have failed.
Yes.
We've got this bigger one here that happened between May and June, and that failed when it moved up above the top of the right shoulder. That then is a failed head and shoulders, which becomes bullish. And then again, we had a smaller pattern up here in late July, and that one also failed and it moved higher. So it looks as if we're getting another failed head and shoulders pattern here, which probably also resolves to the upside and results in further gains. Now, if we zoom out a little bit further, now we're going to look back about 10 months on the S&P 500. The reason I've gone back that far is just to bring in this high from January of this year, and that comes in at 28.75. Now, I'd be quite surprised if we don't go up and revisit that high, and most likely we will then break above it, I think. The market's very calm at the moment, quite narrow daily trading ranges, and the VIX is very low. In other words, volatility is very low. That is the kind of environment that you could potentially see the market suddenly, I don't want to say explode to the upside because that's probably too strong of a word, but you could find that it actually just squeezes up a bit and goes on to make new highs. And I'm relatively confident that we could actually see that on the S&P 500 quite soon.
I suppose the only worrying thing, though, is really what's taking it up are all the tech stocks, the FANGs.
Well,
and
that's
so
it.
there isn't much market breadth, and you kind of wonder, well, I suppose the good side of that would be if those stocks started rallying, then you'd probably get quite a powerful.
It's possible, but you're right
rally.
though, the breadth isn't great. It's been fairly concentrated in a limited number of stocks, and as you say, the FANGs, so Amazon, Apple are 2 of those that have really been quite strong on the US market and will most likely contribute to this moving higher. I think in all likelihood you're right, you probably will see tech pushing this market to new highs. But below tech and outside of that, the rest of the universe of the S&P 500 doesn't really look all that fantastic whenever I analyze it.
Yeah. And then our own market, we look like we've broken down because we were doing nothing. Well, in fact, we're still over a longer term basis doing nothing, but in the short term, it's looking a little bit poorly. Yeah,
so this is the top 40 future that we always look at here. And what's notable is that huge big red candle to the downside that happened last week. Now that occurred when Tencent put out results that were slightly disappointing. And at one stage during the day, Naspers was down 10% intraday on the back of that. So you've seen the market fall quite sharply. It has recovered somewhat, but it now looks to me as if we're kind of testing the underside of this wedge pattern that I'm pointing out there now. And if we continue to fail here at around about this 51,000 area or 51,200, if we continue to fail there and gradually roll over, then I think there's a chance we might actually see another retest of 49,500 and maybe even 49,000 in the weeks ahead. So it doesn't look all that great. Certainly on a relative basis, looking at that S&P 500 chart, that looks still quite bullish to me. This top 40 chart doesn't look as great in my mind.
Yeah, which is one of the reasons why you've been picking offshore shares, so not the overall market. And let's start off with the most recent trade, which was a position that you took in American Express. You've gone long of it. Are you still in that position?
I am still in it, and I'm actually going to try and see if we can extract a little bit more out of this trade. It's almost at our target level now. What I liked about it was the fact that it is in a rising trend, so it was showing good relative and absolute strength. And it had formed this falling wedge pattern in late July and then began to break to the upside in early August. That was what triggered me to go and buy it. So I bought it $100.60 with a stop loss at $98.50. I said I was looking for a move up to $104 here, which would basically be equivalent to the high that we saw in late July. It's almost got to that level now. But given what I said about the S&P 500 and the potential for it to maybe break a little bit higher, I'm going to give this one a little bit more time and see whether we actually can't extract a bit more out of this trade, because it does still look technically quite good to me. Which
is, I suppose, what you would expect to do, want to do in a normal market, if I can use that term. But because you've been taking your profits generally when you're kind of 3/4 of the way to the target. So now you're breaking with your own recently set traditions.
I am, and you're right. I mean, recently we've been sort of banking quick profits, sticking it in the bank and then moving on to the next thing, and this is a little bit different. The reason here is just that I still quite like that technical setup, and based on what I said about the S&P 500 potentially breaking to new highs, this stock exhibits good relative strength in a overall fairly strong market. So let's give it a bit of time. What I probably will do now is run a trailing stop loss so that we don't give back the gains that we've now got. But if there is ongoing upside, I'd like to participate in that. And to do a trailing stop loss on this type of scenario, what you would generally do is look at the prior day low and then set a trailing stop loss below the prior day's low. So what that does is it allows you to stay in the trade provided it's trending upwards.
Yeah.
But if it begins to break below yesterday's low, then it will get you out.
Yeah, and you'll still have made your profit.
Exactly. So you protect your profit, but you allow yourself to participate in any additional upside.
Yeah. Okay, what about something else that you flagged last week, which was a potential short on the DAX, and yet you haven't entered a trade, and it did seemingly what you wanted or what you thought it might do.
Yeah, it's a bit frustrating when this type of thing happens, but it is what it is. What I'd identified on the DAX was that we had this head and shoulders pattern, which was forming whilst the stock was, or the index rather, was below the 200-day and the 50-day moving averages. And it looked to me as if it was breaking to the downside. It had actually broken to the downside when we spoke last week. The neckline there was 12,500. And what I'd said on last week's show was that I would want to see it moving back up to 12,500 and possibly a little bit above that and then reverse down. And that would trigger me, or signal an entry level on a short for me. And we were looking for a move down to 12,100. Now, it did make an attempt to give a throwback to the neckline, but it didn't go back quite as high as I was looking for.
So instead it just fell?
Yeah, pretty much. I was really looking to try and enter a short trade here at around about 12,500. It just didn't get that high, and then it fell away. And it's pretty much reached the 12,100 target now. So the idea was right, the analysis was spot on. I just didn't get in, and as I say, I was particular on my level, and it didn't trade to my level, so unfortunately I sat on the sidelines and watched it do exactly what I thought it might do.
Although we often get this question from viewers who ask on Stockwatch, asking why don't, if a share is falling, why don't you just enter the short? And I suppose you could ask the same point here, but you do want a little bit of a rally to get in before the share starts collapsing, because then it'll make your risk to reward ratio the better. Yeah,
well, that's exactly it. The risk to reward ratio is what you've got to look at so carefully here. In hindsight, if I go back and I review this whole setup now, how should I have traded it? In the first place, what I actually should have been is a bit more alert when it started to make the right shoulder here, and when it formed a shooting star candle there. You can see that where I'm pointing that out now, and it had now closed a gap from a couple of days before. That was the time to really enter a short with a very good risk to reward ratio as it began to form the right shoulder of a head and shoulders pattern. So, if I'd been a little bit more alert, that's what I should have done. So in all, I mean, my analysis was right, but I didn't get to participate in it. It's one of those things.
Well, wear that hair shirt, Garth, and pick yourself.
Yeah.
Okay, on to this week's theme, and it's not necessarily a trade that you're looking to enter into, but it's 3 shares that you want to flag for us. The bats,
yes.
Baudi, Alibaba, and Tencent.
Yeah, that's right. So we all know about the FANGs, the tech stocks in the US, Facebook, Apple, Amazon, Netflix, Google. Now, the Chinese have their own versions. Maybe the acronym is not as well known to everybody, but the acronym for those 3 is the BAT, B-A-T, Baidu, Alibaba, and Tencent. And these are essentially tech shares in China that have done very, very well, along with the global tech rally. why I'm flagging it this week is because there are, to me, what look like some potentially ominous signs on some of these charts for these shares, and I think it's what we just got to be aware of it. So I'm going to start by looking here at Baudi, and what's to me getting me interested but a bit concerned is the fact that it looks as if we have been making a rounding top here over the last year or so. Keep in mind, these are weekly charts, so every candlestick pattern that you see here represents 1 week worth of trade. So we've got these patterns that have now begun to form over the course of a year, and you're starting to see, as I said, a rounding top. The critical support level here for Baudi will be $210. This stock, by the way, trades in New York. So I mean, it's a Chinese tech stock, but this is the share price as it trades in New York. If it started to break below $210, that would not bode well. I don't think it's going to do that right away. It's looking as if it's starting to make a little bit of a bounce from the current level. But if it makes a lower high on this bounce and then begins to turn lower again, then I think we really need to be a little bit careful here. These rounding top patterns, in my experience, often they do signal slowing momentum, and they often do break to the downside. And you end up sitting in those situations where you just sort of think, wow, it just keeps going lower and lower. And stocks like Brait spring to mind. It was one of those. And there's a host of others that I can talk about which have done this in the past. So that's Baudi. The next one is Alibaba. And here again, quite clear.
Not as extreme, but also fairly evident.
Yeah, it is fairly evident. And here your lateral support area is at $165. It has bounced off that level, but what we really need to watch in the next couple of weeks or months maybe is whether it makes a lower high and starts to turn down from a lower high again. Because you can see quite clearly a rounding top beginning to form over there. If it started to trade below $165, that would not bode well, and it would then likely see quite a sharp move lower. Over the following months.
And I suppose Baidu and Alibaba are to some extent academic for South African investors, although unless of course they've taken money offshore and invested in the stocks directly. But Tencent has a huge bearing on what happens to our market.
Exactly, and this is where we're going to start to bring it home, because we'll look at Naspers after this. But Tencent is here, and this one has been forming a rounding top also since October of last year. There's also a head and shoulders pattern that I've identified over there with a neckline at $375. This is now Hong Kong dollars, by the way. Tencent is listed in Hong Kong, so it's not trading in New York like the other two that I was just looking at. The fact that it's broken below 375 Hong Kong dollars here does not bode well technically. And that head and shoulders pattern actually points to a downside target of $275. Now, I know there are some out there that might say that's just absolutely ridiculous. It's never going to go to that target. But I don't think you can say never. I don't know. I mean, I don't profess to know the future. But these rounding top patterns, to me, don't generally bode well.
And the impact then potentially on Naspers?
Yeah, so here's Naspers. Now we're looking back to November last year. This is a daily chart now. What's notable here is that Naspers recently broke below this upward trend from April this year. It's rallied up. It seems to now be struggling at the underneath of the 50-day and the 200-day moving average. This level at 3,000 Rand per share is critical. If it starts to falter and move down and eventually fails through 3,000, that could be quite problematic for Naspers.
Yeah, okay. So tech stocks to watch with an eye to potentially shorting them.
Maybe.
Garth, to wrap up, what do the portfolios look like?
Okay, so our South African portfolio hasn't changed. It's still up 17.5% for the year to date. And then our offshore portfolio has improved a little bit over this week. It's up almost 8% for the year to date, thanks to the mark-to-market profit that we're seeing there on American Express.
And then very lastly, you have a course coming up fairly shortly.
Yes, on the 15th of September, I'm doing a high-probability trading course in Joburg. It's running at a spring promotional price of 1,990 per person, and you get a 3-month Traders Corner subscription thrown in as well. So anyone that's interested and would like the details, please send me an email, garth@traderscorner.co.za, and I'll send you all the info.
Great. Garth, we have to leave it there. Thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.